Hello listeners, welcome to PayTech Bytes. Today we will continue with part 2 of our discussion with Krishnan, Vice President of Enterprise Risk and Compliance at Worldline India, and our topic of discussion is Enterprise Risk Management Framework. So can you share some examples where lack of risk management led to disaster for an organization? Looking back, some of the instances or case studies.
Yeah, there are lots of them in terms of what we can learn from. So basically, in an ERM failure, or I wouldn't say ERM failure, I would say an organizational failure because of failure of risk management consciousness, or for that matter, practice. If you see globally, if you see when the 2008 crisis speaks a lot about it, because largely the entire meltdown in 2008 was because of
the
subprime risk, as we call it, is purely because of the credit risk, where there was an overplay on credit risk. There was too much of credit risk being undertaken. Like in our case, if you talk in terms of our context as a payment company, we would call it merchant risk. We'd call it merchant chargeback risk. If you try getting into various segments of merchants where we are not prepared to understand the possible default of these merchants, then obviously you are carrying a lot of chargeback risk on us. This is one. And so 2008 crisis, a lot of institutions, like say large institutions like Lehman Brothers, AIG, insurance companies, and a whole network of hedge funds, they failed. They failed because they started biting into too much of credit risk than what they can manage. So this brings us to a very important concept of risk appetite. So those institutions which did not identify their risk appetite in relation to the capital that they invest in the business, obviously went overboard in taking more risk than what they can chew. So it is the same old good fable, like you basically to stretch only to the extent your carpet is, or either you extend your carpet. So basically, if I have, let's say, $1 million in my portfolio, then I can't be taking 10 times of that particular capital risk unless and until, I'm so smart that I can actually save and make money. So you basically need to take risk only to the extent how much you can leverage. When you go beyond, then obviously you are exposing too much into financial risk. This is one particular example.
Understood.
Yeah. So other example also, in terms of Satyam and other local, in India, we've seen so many banks in the past, probably even fund houses in the early days of the mutual fund industry. And also in terms of, certain technology companies like Satyam. What went wrong was a combination of two things. One is lack of corporate governance. A lot of, I will use the word Ponzi scheme. Ponzi scheme is where you basically, you launch one fund and then you're not able to perform in that. So you launch another fund to basically, try to, cover the non-performance of the underperformance of the other fund. And you keep layering till the time that all of these become bad eggs. So at that time, the investors are caught unaware and you lose. So these were certain, instances which happened. There's a lot of broking, capital market institutions which have gone which have gone belly up, purely because of the fact that a classic example, something like an Indian bank, merchant banking, way back in 95, they were the earlier trend centers in investment banking. Some of the best, I would say they were one of the strongest competitors to SBI capital markets. But what went wrong was, they took too much of risk on one particular industry which was called as shrimp farming, aquaculture. The moment the aquaculture industry had actually a biological, outbreak on those, products, which are basically nothing but fisheries, right? So when they had a biological outbreak, the entire particular industry inventory was infected. So all those units which these guys supported in the capital market, they took underwriting risks. It all came on their net worth. So that is also a matter of concentration. You take too much of bets on a single industry or a single sector, which also makes sense to us. Like as PayTech companies, we need to diversify our merchant base. We can't just piggy ride too much on a particular segment. So those are the areas in which you basically examples I can say for us. In the recent case, even with certain German PayTech companies, a failure that has occurred in some of the German PayTech companies purely because of combination of operational risks, not enough due diligence, and they get caught into compliance issues, and which actually causes a closure to the company. So these are some of the examples which you
can understood, Krishnan. I think it was very insightful. So one final closing remark in terms of some tips on how we build an effective enterprise risk management framework for our listeners.
Yeah. So see, when you try to, let's say we are at ground zero, which we were probably 4 years back, right? We wanted to build our ERM in our own company. So the usual style is you start from the tone at the top. So basically, the leadership must own the responsibility. They must own the fact that they want to now see enterprise risk assessment and basically identification and mitigation as a specialist kind of a subject which they want to engage with. And they would want to bring in the culture that this is something that they need to sensitize about across every activity that the organization does, whether it is business, whether it is sales, operations, IT, or for that matter HR. Once this ownership is set, then comes the question of putting the mechanics in place. So that's when you basically gather a team and you set a charter or an objective. Usually these approaches, when you begin your ERM, you begin first in probably the first 2 years goes a lot in terms of discussing about risk exposures, identifying risks, generating basic reports or where the risk exposures are, so that the management is aware that these are some of the risks exposure. And there's a lot of dialogue, debate and discussion and brainstorming, which results in certain concrete actions. Once this particular culture is set in, then the next maturity starts, where you start organizing yourself in terms of risk intelligence. Try to look in terms, start now talking in terms of what kind of board level reporting that you can start doing more effectively, dashboards, and also in terms of risk appetite. That's when you start talking in terms of risk appetite. So probably after a 5 or 6 year maturity cycle of ERM then starts actually closely associating itself in terms of strategic decisions that are taken, whether it is a strategic business option decision or a product, or for that matter a partnership. That's where we start doing vendor risk management, not on the mechanical side as what we do today, but also in terms of being part of the decision in terms of whether to go ahead with a vendor or not. Similarly, in terms of business strategy, evaluating business strategies and giving a management on the board a kind of a snapshot in terms of how does it look from a risk angle. So that's the end maturity. That's when we actually create holistic value.
Understood, Krishnan. Thank you for sharing your time and insights with us today. And thank you for listening to this episode of PayTech Bytes. We hope you find the discussion on enterprise risk management framework insightful. Stay tuned for more. See you at the next episode.
Thank you, Rahul. It's been a pleasure to discuss with our fellow colleagues on this topic. Thank you.